If silver does that, our projection is you could see silver this year $300 to $500 an ounce. Gold made a high in 1980, then made another in 2011. They were each eightfold gains from bear low to bull high, higher bear low, next bull high. Eightfold gains from bear low to high. Okay. Just to go to 8,500. Wow. You think that's crazy. No, it's not. It's done it twice before.
If I have targets here, I've been speaking about my targets for years. I'm very open on how I believe the price action of gold and silver is going to play out. I still feel, even at today's price, it's the most undervalued financial asset of all time. And my bottom target right now is $650 an ounce. Could be potentially way more than that.
Market analysts Michaeloliver and Gregory Mannarino forecast a parabolic trajectory for precious metals, grounded in historical market cycles. They highlight that gold's major bull runs in 1980 and 2011 both resulted in eightfold gains, a technical pattern that now points toward a price of $8,500. Silver, however, is poised for even more dramatic acceleration. Current projections place the metal between $300 and $500 in the near term, with long-term technical models suggesting a floor of $650 per ounce. Describing silver as the most undervalued asset in financial history, they argue that these targets are not merely speculative, but inevitable repetitions of established market behaviors that few investors are prepared for. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
The question then is our assessment of silver in particular. We think gold and silver are going up a lot more this year, a lot more. Okay, multiples more. But silver is going to beat the pants off of gold. Silver is very depressed to gold. We all know that. It's been depressed for a long time, so that hasn't worked. But the technicals that say it's shifted into an outperform versus gold occurred in November at the close. By our metrics, we said, okay, game is on, silver's going to launch versus gold. Since it's now up to 2% of the price of gold. Early this year, last year, it was at 1% of the price of an ounce of gold. So it's doubled in relative value over a year. And if you go back in history and look at where was an ounce of silver versus an ounce of gold as a percent, let's say the 1980 bull market peak when we hit $50, that old range, okay? It was at 6.5%. 6.5. We're at 2? Okay. And in 2011 peak, when we hit 50 the second time, it was at over 3%. We're at 2. Our technicals show us that spread relationship is broken out, and we're likely, think about this, silver's been in a 50-year, half a century dull range, suppressed, whatever. Gold hasn't been. Gold blows the heck out of every prior bull high. Copper's not where it was back in the 1970s, 80s, 90s, 2000. It's 4 times that price. Silver, for some reason, has been contained. Whether that's manipulation or a combination of events, it made a mistake. And whenever markets make a mistake, they tend to compensate for it and quite often overcompensate in a tantrum. This has happened many times in markets. It's not usual, but it happens. Copper did it in 2005-06. Lead did it in 2007. We quadrupled in a couple quarters to a new reality. If silver does that, our projection is you could see silver this year $300 to $500 an ounce. Gold's reality is this. While silver's been capped in this half a century silly range compared to any other asset on the planet practically, gold hasn't. Gold made a high in 1980, then made another in 2011. They were each eightfold gains from bear low to bull high, higher bear low, next bull high. Eightfold gains from bear low to high. Okay. Our bear low is $1,050 in December 2015. Okay. We're only a little bit more than fourfold right now. If we went to eightfold and quote, did it again, in other words, the norm, okay, have another normal gold bull market, like the 2 we've just had in the past 50 years, you'd be $8,500 gold just to do the norm. And yet we're in a different world now. Like the T-bonds. They're not, they're in crisis mode. They weren't back in those particular times. We're in a different, so just to go to 8,500, Wow, you think that's crazy. No, it's not. It's done it twice before. And yet silver is just now taken out its 1980 high and its 2011 high. It's got a lot of catching up to do. And also on that percentage basis, ounce of silver to ounce of gold, it's off the page cheap. And what if silver, again, not only took out its 50-year highs on price and went nuts and went to a new reality? Why shouldn't those spreads go up and challenge or maybe take out those highs? 6.5%, 1980, 3.1%, 2011. We're at 2%. And if gold is 8,000 bucks, only 8,000 bucks, a normal eight full move, and silver goes to 3% or goes to 6.5, it's off the page. So that's what we're looking at, and it's not going to be incremental arm wrestling. It's going to be sudden.
Market analysts Michaeloliver and Gregory Mannarino predict a massive tantrum in silver prices, forecasting a rapid repricing similar to the copper explosion of 2005. While gold is projected to hit $8,500, mirroring the eightfold gains seen in the 1980s and 2011 bull markets, silver is set to outperform dramatically. Currently sitting at just 2% of gold's price, silver is historically undervalued compared to its 1980 peak of 6.5%. Oliver argues that silver's 50-year suppression has effectively broken, with technical indicators signaling a breakout that could propel prices to $300 to $500 this year alone. Unlike typical incremental market moves, they warn that this correction will be sudden and explosive, a catch-up to a new economic reality. Let's get into the interview.
This isn't even the beginning of where we're eventually going to go in my perspective. I have targets here. I've been speaking about my targets for years. I'm very open on how I believe the price action of gold and silver is going to play out. It all is based upon what I look at is the inevitable 1-to-1 ratio, which will eventually achieve, or a 2-to-1 favoring gold ratio, the gold Dow ratio, at one point here, and that's really that's where we're going to see the movement. It's all going to happen at a point where the debt market implodes on itself, and that is going to occur. It's the most monstrous bubble in the history of the world, and it's being fueled with an enormous amount of ferocity right now. There's a massive deception campaign going on in the United States. Look here, don't look over there, don't pay attention to what's actually going on. But I think that the people that follow our work are well-versed in silver, gold, the importance of having these assets in your possession as opposed to paper derivative contracts, futures contracts, all that nonsense, and I don't want anything to do with it. I don't own a single paper contract. I have traded them in the past. This is pretty much common knowledge. But as for owning this stuff a long term, I want nothing to do with it at all. Despite the fact that people have made, probably incredible gains in the paper derivatives market, but I have no interest in it at all. So yeah. This is interesting, the move price action here of silver, gold, silver more specifically. But we haven't seen anything yet. This isn't even the beginning, in my view. People get caught up in a paradigm. It's very difficult for them to reason their way out of it when they've been conditioned into it. This kind of a thing is ancient. It's the mechanism, it's the system, how it preys on people and keeps them in a state of fear. Fear is paralyzing, and I think we all know that. It's interesting that you brought this up. Just 2 days ago, I was talking to a very good friend of mine who had a few dollars laying around at the time, and silver was $8. And I said to him, what are you going to do with all this cash you have laying around? He goes, I'm really not sure what to do with it. What would you do with it? I said, I'd go out there and whatever I had, I said, I'd go buy silver right now. He didn't buy a single ounce. And he went back, and this is just 2 days ago. He's like, Greg, I could kick myself for not listening to you back then. This was $8. Incredible. And then when it hit 14, we had the same conversation, and he was still mulling it around if I should do it, if it's too late. And I get the same thing now as you probably do as well. People every day, they write to me, Greg, should I buy? Should I buy? Should I wait for a pullback? My answer is buy. Wait for a pullback for what? It may move around a little bit. Of course, it's going to. Trying to pinpoint that, I mean, you gotta be nuts. I don't play that game, and no one should be playing that kind of a game. I still feel, even at today's price, it's the most undervalued financial asset of all time, and my bottom target right now is $650 an ounce. Could be potentially way more than that, depending on, again, what happens in the debt market, which people are finally realizing, I think, at least I hope so, more and more, at least those that follow our work, that the United States has devolved into a debt expansion empire on a scale that no one can actually get their head around. It's an incredible thing. Although you and I have been saying this would happen for the longest time, it's not done. It can only function by expanding the debt, by devaluing the currency on the back of artificially suppressed rates. That mechanism is not going to stop. The world doesn't want the United States anymore in its current capacity. They don't want our products. They don't want our currency. They certainly don't want our debt. And they've been pushed out of the U.S. debt market via the Treasury Fed complex, who's cornered the market. And I think that people don't realize the gravity of how important this is, that now we have this Fed Treasury merger in here, literally buying it all. By keeping rates artificially suppressed, they've made themselves the lenders and buyers of last resort. No one wants it. No, who'd want to buy our debt here? There isn't. This mechanism has pushed natural buyers away. So, I mean, this is just another thing that you and I have been speaking about dude, we've been out here for a long time. And if people were to sit back and look at our talks that we've had over the years, they would say, wow, this is kind of very incredible that these guys were able to put this into perspective. But it's just too simple. For me, all I do is, I look at dynamics that are in play. I understand clearly how cash moves through the system, why it moves through the system, and the mechanisms behind it. And that allows us to say things like, for example, silver is so undervalued, even right now, gold, incredibly undervalued right now.
In this urgent market update, analyst Gregory Mannarino warns that the current metals rally is merely the prelude to a catastrophic debt market implosion. Describing the U.S. bond market as the most monstrous bubble in history, Mannarino argues the nation has devolved into a debt expansion empire, sustained only by a toxic Fed Treasury merger that has driven away natural global buyers. As this artificial system fractures, he predicts a violent reversion in the Dow to gold ratio, potentially reaching 1-to-1. With silver remaining the most undervalued asset of all time, Mannarino sets a base target of $650 per ounce. He urges investors to reject paper derivatives and secure physical metal now, viewing the coming collapse not as a possibility, but as a mathematical certainty. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.